Hello viewers, welcome back to our YouTube channel, KC Accountants Education Center. And today we want to look at the last part of our dividend policy, and that is to do with the dividend capacity. The dividend capacity. Now, of course, where we are heading now for the dividend capacity, it's an area that I've never seen as far as CPO questions are concerned, but we don't know. But it is more in the SCCA papers. So we needed to look at it. It is very easy thing, but mostly examined in SCCA papers, and it will never be theoretical. It is always a computational number, and the examiner might give you a balance sheet or a trial balance. So whichever statement the examiner has given to you, you'll be able to draw what we need from those statements that have been given to you. Now, what do we mean by dividend capacity? The word dividend capacity means how much money are you going to pay for dividends. In other words, which figure are you going to pay? Like which figure are you going to pay as dividends? Are you going to pay out as dividends? So that's the figure that we are trying to look at, and that's why I'm saying it will never be theoretical. It is always a computational part, because we are trying to look at which exact amount are we going to be paying out as dividends based on the profits that we have made for a given financial year. So if, for example, if let's say you have made 9 billion, this is profit after tax. You have made 9 billion profit after tax. Then the question is, how much are you going to pay out as dividend on these 9 billion that you have made? Are you going to give it out, all of it? Because this is profit after tax, but it's not exactly what we give out. They might tell you that this is the profit after tax, but when in actual sense they have given you a different profit after tax. So you have to be careful which profit after tax have they given to me. So the figure that we are looking for is the figure that we are going to be paying out as dividend, the whole dividend amount that we are going to be distributing to our shareholders. Now, one thing I want you to understand is that the dividend decision of a company, dividend decision, the dividend capacity, sorry about that, the dividend capacity of a company, of any company, is what we call the free cash flows. Free cash flows to equity. They abbreviate as FCFE. Free cash flow to equity. However, in our financial statements, we always prepare, we have two types of cash flows. We have this first one, the free cash flow to equity, and at the same time we have what we call the free cash flows, which is abbreviated as FCF. Now, what's the difference between the two? Free cash flow to equity and then the free cash flows. Now, free cash flows, That is the money that is available for the company to distribute to both equity participants and then the debt participants. So free cash flow to equity is always available for both debt holders and the equity holders. So this free cash flow, that is the money that is going to be available for distribution to both the debt holders and then the equity holders. In other words, you distribute to your shareholders and you also distribute to those people that gave you loans, whichever kind of debt finance it was. So that cash flow is what we call the free cash flow, is the one we distribute to all. Now, the free cash flow to equity, in other words, when we are determining the dividend capacity, we look at the free cash flow to equity, which is the money available to be distributed to only, this is only equity participants or equity shareholders. Free cash flow to equity is available to only equity participants, those who have bought ordinary shares or what we call common stock. So the examiner might give you data that is a little bit maybe mixed up, and maybe is just trying to confuse you a little bit. But what you need to do is you need to arrange so that you can be able to compute what we call the free cash flow to equity. And that free cash flow to equity is what we call the dividend capacity. So how do you separate free cash flows to the firm? Of course, this free cash flow to the firm means that that is the cash flow that is available to both equity participants and then the debt participants. So how do we separate the free cash flow to the firm and then free cash flows to equity? So we can have a format. Let's show a format for dividend capacity computations. Format for dividend capacity. So the story begins when you have free cash flows to the firm, which is the money that is available to all the debt and then the equity holders. And immediately you expense what we call interest. Then it means that the debt holders have been paid off. And what is available is money that is available for distribution to equity holders. So what we start with the profit before interest and tax. The profit before interest and tax. So we take it there. This profit before interest and tax is what we call the operating profits. Let me put it here, operating profit. That is the operating profit. Of course, on this amount, we add back non-cash items. Add back non-cash items. Non-cash items like depreciation and amortization. They are supposed to be added back. Then we less investment in non-current assets. Investment in non-current assets. And here we take the increase. The reason why I'm putting the increase is because we are lessing off. Remember, what we are trying to do, we are trying to arrive at the cash that is available. So the non-cash items are supposed to be added back because they don't involve into what we call cash movement. Then the other, we are supposed also to less investment in working capital. Investment in working capital. We take the increase also. If there is a decrease in working capital, then that one is supposed to be added back. So this one is supposed to be deducted also. And then we less also the tax. We take off the tax. And once we take off the tax, what we are left with is what we call the free cash flow to the firm. That is the free cash flow, or what we call the FCF. That is the money that we are left there. Free cash flow. Now, once we go to the free cash flow, it means this is the money that is available to both the equity participants and then the debt participants. So what we do, we go back and take off the interest. So this is where it starts. We less off, less interest expense, whichever amount it is. Once you take off the interest expense, it means you have paid the debt holders. Now, what you have left with, the figure you have left with is what we call the free cash flow to equity. That would be the figure. So this is FCFE, free cash flow to equity. And that's the figure. This figure here is the money that is supposed to be paid as dividends to the shareholders. So the question will be, what is the policy of the company? Are they going to be taking a constant, because this is what is going to be declared as money that is available to the equity participants. Once you have declared, then the question is, how much are you going to be paying per share? Are you going to pay using a constant dividend? Are you going to pay using a constant growth? Are you going to pay using... So once you have allocated all the money to the different shareholders using the dividend policy, you are not going to apply all of them. You pick one, then you apply that. You can change it when you need to. So once you are done, of course, you go the other payment, whether you are going to pay the payment methods, whether by cash, split dividend, bonus issue, scooped dividend, and others. So now someone is going to be wondering, why are we adding back the depreciation here? The non-cash items. We are saying that these non-cash items are supposed to be added back. Someone may be wondering, why are we adding back depreciation? Because we know depreciation equals the amount that, it equals the amount of reinvestment needed to be made, like to be maintained. Like you try to keep some money aside to make sure that at the end of the day, this asset like you can use the asset, then at the end of the useful life of the asset, you can be able to buy another asset, same asset. So the depreciation is just the amount, you keep it aside, but it's not a real expense that it is going to involve in cash moving out of the business. So you maintain, it is an expense that is going to help you maintain the current productive capacity. In other words, in the question, if you see depreciation of, let's say, 40 million, and somewhere in the question, the examiner says that we need 40 million to reinvest in assets, then don't add it back. Like, you don't add back depreciation because it's money that you have set aside, but you need it for reinvestment. So you look at the notes that they have provided. Then the other thing that we can conclude with is the fact that we had looked at some ratios earlier. We looked at some ratios. Those were market ratios, and we've said that the examiner can tell you to comment about them. Some of the ratios that we looked at dividend per share, because what is going to happen is that the examiner can tell you to comment on the dividend policy of the company. What are you going to do? Of course, when you are commenting, you use some of these ratios. So if an examiner tells you to comment about the dividend policy of a company, then you could be forced to do some ratios like the dividend per share, like the dividend payout ratio, and others. So we can have some formulas just to highlight as we close this one off. So dividend per share, sometimes it is abbreviated as DPS, dividend per share, which is the formula is dividend declared or paid. Because once the dividend has been declared, even if they have not paid it, they will pay over number of ordinary shares. 2, the other ratio, this is the first one. The second ratio you can comment on could be the dividend payout ratio. Dividend payout ratio. So the formula for dividend payout ratio is, of course, dividend declared over, you can use profit after tax, or what we call the earnings after tax. The other, you can also use it could be in a percentage, or you can use dividend per share over earnings per share. It could be per unit or per share times 100. Then of course we have the last one. Maybe you can talk about the dividend yield. Number 3, dividend yield. Those ones could be enough. The dividend yield, of course, it is dividend per share over the market price per share times 100. So that's all that we wanted to look at as far as capital structure and dividend policy are concerned. So one of the topics that we are going to look at next, we are going to start with our portfolio theory. Portfolio theory, or what we call portfolio analysis. Portfolio theory or analysis. It's a very good topic that we don't look at in our level 2, but here on level 3, it's very big topic that we do so many computations, and it has more of computations than theoretical aspects. So that's what we shall begin with when we are continuing with other series of advanced financial management. Thank you for watching. Endeavor to subscribe. Make sure you share to your colleagues and friends so that they can be able to have the same benefit that you have received. Thank you.